My name is Gabe Lini, and I'm going to be going over the two best, most profitable entry models that you need to be using in today's market. If you do not use these entry models, you seriously are missing out on so much potential gain that you otherwise would not have made if you were to use a different entry model. Most traders don't lose because of bad strategies. They lose because they're either too early, too late, or they're chasing the market. This leads to your wins becoming losses and eventual missed trades because you just don't know where to enter on. But that's okay, and it's not bad luck, it's just bad entries. And I'm going to be showing you two of the most useful entries that you are not using in 2026. These two entries will take you from being unprofitable to profitable as long as you use them consistently with a predetermined bias and strategy already outlined in your model. The solution is this: not to enter off your instinct or only using your discretion to figure out trades, or honestly just hoping on prayers that your trade hits. It is to use these two of the easiest entry models. And if you actually understand this, you'll stop chasing price and start letting the trades come to you. The first one is, as you might have guessed, the market structure shift. What is a market structure shift? Well, the market structure shift entry model is how you stop guessing and start reading what the market is actually doing. Here's a small outline of what the market structure shift is actually. This is a bullish market structure shift. It is when price breaks above a swing high and closes above the body of the previous candle, forming what you call an order block. The bearish market structure shift is the same thing, but it's just on the downside. So instead, you're breaking past the swing low to then form the order block on this little leg. Here are some chart examples that we can go through. First of all, we have a 2-minute example right here. As you can see, price pushes down into some form of key level. Of course, we're not going over key levels in this video. This is just an entry model video. But to use these entry models, you must have some sort of foundation in price action before you take anything off a market structure shift in this case. As you can see, price forms this swing low, right? We then push our way above past the high, and the high is not just the body, that would be a CISD, it is the actual high of the candle wick, which on the 2-minute looks like a wick, but if you were to scale even lower, it would look like actual candles. When price breaks above this high with a solid candle closure, this little block right here is considered an order block, and this is ideally where you want to be entering in. When price retraces back to this order block, which is this down close candle, before the series of up close candles, this would be considered a breaker block. When these are aligned, that is an even better entry. If we go over here to the 3-minute, we can see another example of an order block, which is this one right here. As you can see, price pushes lower, breaks below, forming an order block on the 3-minute. Price then goes back up, taps back into the body, and in this case, almost the CE, likely the CE, to then continue down lower. Your entry would have been right at this order block, as you can see here on the entry. This is another even better example on the 5-minute. As you can see, price again taps off a key level, pushes its way up, closes past the swing high formed previously, as you can see with this candle wick, then pushes back down into the candle body, but most importantly, respecting the swing low. So as you can see here, TP for this trade was right here with a 1-to-1, but you could have very much wanted to enter right here with your stop loss down here and a take profit at this internal buy side liquidity. We can see even another example right here. As you can see, we close above the swing high on the 3-minute. Price then pushes its way back down to perfectly tap the body of this 3-minute. That's where you would want to enter. With your TP can either be at the edge of this fair value gap or the edge of this order block, as we pretty much tapped that. These are just a few examples on the NASDAQ, how a market structure shift actually looks on the charts. But again, how do you actually enter into these positions? It is really, really simple. You want to use either limit orders or market orders. And we can use the example we went through before, which we can see this is on the 2-minute time frame. That price pushes up. We form the market structure shift right here as we close above the swing high formed. If you guys don't know, a high is considered a up close candle, right? Followed by another down close candle. This is the high of the candle. You need a pair of the two. If you were bearish, it would be the same thing. You would not want a down close candle and an up close candle. You see? Think of this as an up close candle. This is a down close candle. This is the low. As we already mentioned before, you have the entry at the body, which is also a question mark because not all the time will price retrace exactly to the order block body, but it is the best RR possible on certain trades that you could take for the market structure shift entry model. The market structure shift occurs at reversal points in price action. Do not follow every market structure shift that you see. There are outliers aligned with this. As you can see here, you see that price ends up tapping off some sort of key level, pushing up to break past this 3-minute order block right here formed, or this breaker, this order block body, but price doesn't return down to this level. Why is that? It's because you can see here on the higher time frame, this entire down move is considered an order block on a higher time frame, and you can see that price perfectly retraces into the wick of this candle, which is the beginning of the downward movement that forms the order block. You just have to see on different time frames and align them. Outliers are common in the market structure shift model, but if you understand how to look at different time frames, you can easily understand where price is going to retrace and use your limit orders or market orders to tap and enter before price moves without you. You should be taking your entry at the closest order block, aligning with your stop loss. What does this mean? So if you can see here, this little illustration, we have that order block, right, formed right below after price pushes up, forming a market structure shift, correct? To then push down into this order block again. You want to be entering at the closest order block. Whatever time frame this is, let's just assume this is the 3-minute time frame. This order block might be multiple different order blocks on the low time frame, multiple different candles. You want to be entering at the highest most candle of the given time frame, correct? Because price will not always retrace exactly to where you believe the market would go, as it is the lowest most order block. You want to have your entry aligned not only with price action, but with your stop loss. You do not want to be entering where your risk will end up going far too great than you can really withstand and potentially losing a lot of money if you end up missing the bias or miscalculating. So you want to have your stop loss at the protected low, wherever amount of points you have in your model or anything. I right now have 65 points as my max stop loss for my given model. So if you're trading 5 micros, that is around $650 of drawdown I'm giving myself. So having your stop loss at a protected low is always the more intelligent move. The market structure shift only works when aligned with the high time frame PD array levels that determine your bias. What are these high time frame PD array levels? These will be the daily, the 4-hour, 2-hour, 1-hour for value gaps. Same, daily, 4-hour, 2-hour, 1-hour order blocks. All of this with the CE included. If you don't know what CE means, it means consequent encroachment, which is just the 50% mark of any of these PD arrays. So let's say you have a fair value gap, right? The 50% of that will be considered the CE, all right? Market structure shift entries don't just apply to reversals and retraces. They are common and will be respected whenever an objective is chosen. I will go over the week on the charts to explain to you guys more of where you can find this entry model. You want to have some sort of high time frame PD array level. For example, a 1-hour fair value gap where price ends up tapping off of to then form your market structure shift entry model, which would be right here, to then enter and then get into the move with your stop loss at the foundational level previously seen. That's the basis of what the market structure shift is. Now we're gonna go over the second best entry model, which in my personal opinion is one of the most popular entry models that's going around in the futures community right now. It is the inverse fair value gap. If the market structure shift is solid and reliable, the inverse fair value gap is quicker and cockier in a sense. Well, so what is the inverse fair value gap? I have an illustration right here of a bearish and bullish example. It is basically when price inverses a previously respected fair value gap on any given time frame, right? So you see price is in an uptrend, we're going up, and then all of a sudden we go ahead and reverse and inverse the fair value gap that previously would have been respected if price were to continue bullish. So this is a very clear indication of a reversal where price then ideally would retap into that exact inverse fair value gap to then continue down lower. This is a bullish example. The same thing literally just flipped, where you go ahead and push up, inversing a fair value gap previously respected to then try to get an entry right at the level of the inversion. Why would you use this? Well, like previously stated, not all market structure shifts will grant you a retracement, and not all reversals will grant a market structure shift. The IFVG model is great for early entries, and if the 2-minute is for market structure shifts, the 1-minute is for inverse fair value gaps. This is a very important tip that you really want to be following. I found through my experience that the 2-minute is amazing for peeping out market structure shifts. If you use the 1-minute for market structure shift, you might get confused a little because there's many different candles and each 2-minute is split into 2 different candles. Whereas the 2-minute just shows you the most basic market structure shift. The 1-minute, however, shows more fair value gaps than the 2-minute would, since there are more candles. This is why the inverse fair value gap is useful, because you need to be seeing these fair value gaps being inversed to then get an entry. And if you are taking a trade off of a foundational level, like a 1 hour or 4 hour PD array, then you are very confident into taking the quickest 1-minute inversion possible, which you just can't see on the 2-minute because the 2-minute hasn't even formed the market structure shift yet. Still, price is fractal, meaning all time frames share these attributes. It is just these 2 time frames that, unless you're trading on the 30-second or 15-second, you're able to see the most basic raw information needed to enter as quick as possible, if you understand. Here are some chart examples from NQ. You can see here on this level that price clearly taps into some sort of higher time frame level to then reverse off this. But before we end up making that market structure shift, we see that the 3-minute already has a fair value gap. Now, if we were to continue going lower, we would respect this, kind of like how this candle did. You see this little high? We tap into that 3-minute and then push back down. That is what we want to see if price is respecting the fair value gap. Instead, price goes and disrespects it by closing above this inverse. Ideally, you'd want to wait for price to go ahead and retrace back into this, but you can just enter off the closure, which is what most people actually do. Here is a 2-minute example, whereas price forms a 2-minute fair value gap right there, which then price goes ahead and inverses on the very next candle after tapping into, you guessed it, a 1 hour fair value gap. What happens after? Price ends up retracing back into this inverse, pushing a little bit lower, but respecting this low, right? So your stop loss is obviously at this low, and you can target external buy side liquidity, which you can see gets taken right here. So this is a good trade. But the star of the show goes to the 1-minute. The 1-minute is the best for inverse fair value gaps, and you really need to be looking at the 1-minute if you want to take trades with this entry model. You can see here that price is pushing down. We tap into some sort of higher time frame level. Price has a bearish fair value gap formed. We have 2 of them already. This first candle ends up inversing this first inverse. The second one is not inversed yet. You can enter off of this candle structure right here. If you know your model and you know that you're already bullish, right, based on the higher time frame PD array, you can enter based off the closure of this inverse fair value gap. Or you can wait until this one gets inverse, which it does right after, 2 candles left. And what does price do? We retrace back into this first inverse fair value gap. But not a lot of people are just gonna wait for this entry to happen, right? Nobody's gonna set limits right here at this inverse. People would rather just enter right at the first one or the second one, right? And this is all before a market structure shift can even be formed, correct? You can see this high doesn't get broken past until here. Even then, this candle doesn't close. So it's much faster than market structure shifts, although it might scare you a little just how quick they are, because price can wake you out, SMTs can get you, or you could just get the bias wrong. So how do you enter? It's really simple. It's super simple, guys. You want to use the 1-minute time frame to enter off first the inverse fair value gap formed with the closure of the candle going through it, or you can enter off price retrace back into inverse fair value gap. Price will retrace back into these IFVGs just like a market structure shift retraces to an order block. This is not always though, and most commonly you want to be entering off that first inverse being formed, that first candle closure. If you want to get the best entry, yes, you can wait until price retraces, but you won't always get this, all right? I would only use this, okay? If you have an example where price is pushing up, we go ahead and inverse. Price is already kind of pushing all the way down and you don't really want to get an entry all the way back here in discount. So what do? You wait for price to end up reversing into this IFVG to then enter and then push down. It's a better entry than if you were here, and you get better RR with your stop loss up here, TP down there. Of course, there's always going to be an outlier. We use the same example as before. Price inverses the 3-minute, but doesn't offer a good retracement. So, I mean, where do we enter right here? We inverse this. This gap is up here. Do we want to enter here? Our stop loss is going to be kind of long. You can see there. We can enter off the candle closure, but by that point, your RR is a bit too large. This is why we make sure to start off on the 1 minute. The 1 minute time frame and benefits of the IFVG. Because in this 3-minute range, there could have been multiple 1 minute fair value gaps formed, or not. I'm just saying the 1 minute has the most potential benefit to be used on the IFVG model. So we have an example here of a 1 minute pattern where price forms 2 different fair value gaps. You can see that this first one gets inversed right after some sort of high time frame PD array level gets tapped into, and you could enter right here off an inversion fair value gap if you want to set limits here, or if you want to just enter right here at that candle closure. The first fair value gap that gets inversed on the 1 minute is a sign of an upcoming reversal. If price forms an IFVG here with a solid foundation from a high time frame PD array, this will not be respected until an opposing confluence is met. So if you guys understand this, then that basically means in shorter terms that when a fair value gap gets inversed on the 1 minute, after you tap into high time frame PD level, this intermediate term low, that's what they're called, we call these intermediate term lows, should not be disrespected. So this is where you should put your stop loss when your entry is right here, take profit up here, and you can expect, right? You can expect all this to be disrespected only once we reach a higher time frame PD array, which is opposing like another daily fair value gap, 4 hour, 1 hour fair value gap, or a mid time frame PD array, right? Which is some sort of 15-minute fair value gap order block, 5-minute of the sorts. And lastly, of course, is liquidity. If we sweep liquidity, we can be certain that price is going to have some sort of reaction, okay? Especially for their key levels. So why 1 minute and not the 2 minute, 3 minute, or higher? Well, your entry off the 1 minute IFVG provides the earliest entry, which equals the best RR. So even if you lose this trade, it is less of a loss than if you would have waited for price to push further. If you want a clear example of this, let's imagine there is a inverse fair value gap and a market structure shift, right? If you were to enter on the inverse right here and price was to stop you out down here, you still would have lost less than if you were to enter off the market structure shift right here and lost as price went down, correct? Since price has already pushed further than the inverse fair value gap and your entry is higher. You get me? Opposite for bearish. So then, market structure shift versus IFVG. Which one is better? Which one should you choose? The market structure shift is more solid and reliable. You have a higher protection on your stop loss. You have more opportunity to enter, and you have higher time frame accessibility. Since the 5-minute and the 15-minute show lots of order blocks and market structure shifts more often than they show inverse fair value gaps. The inverse fair value gap, on the other hand, is quicker to enter, it is easier to enter, and you have a better RR, right? Because you're entering earlier, meaning you have more potential to gain and less to lose if prices to reverse on you. So which one do we choose, everybody? Which one is the best entry model for you guys to choose? I say, why not both? All right, the market structure shift and inverse fair value gap are both very, very useful to enter off of. And honestly, sometimes one of them will show and the other won't. And the other will show and this one won't, right? So you can pretty much use them wherever they are. It is all about the foundation. But these are the two best entry models that you need to be using. You want to be using the market structure shift on the mid time frame on top of already using it on the 2 minute, 3 minute. Sorry about the handwriting, but you don't want to be using this on the 1 minute, all right? Not the 1 minute. You want to be setting limit orders on these order blocks and where you think price is going to come back down on. And if you use this, it is good for wanting to add added confirmation. When you want to use inverse fair value gaps, you're probably looking to enter more quickly, get better RR, and have very high confidence on the bias already. Simple tip. Sometimes market structure shifts will occur before an IFVG and vice versa. You want to be using your 2 minute for market structure shifts and the 1 minute for IFVG. I have gone through thousands of hours on the market, and this is the one tip I have found to rely on the most when entering into my positions. The 2 minute for market structure shift and the 1 minute for IFVGs. And yes, you can go lower, 30-second for IFVGs, but if you don't have the premium and trading view like many beginners do, there's no reason to buy it. You can really just get by with the 1 minute as well, all right? So now I'm gonna go ahead and get into some real chart examples of this past week. All right, so we are on the charts now, the IRL charts. We're gonna go to Monday, April 27th, all the way to Friday. So I'm just gonna show you guys some examples of where you could have entered in on in these kind of trading environments. So you can see here, we already have a 4-hour fair value gap. We're gonna zoom in here and go to market open, where price already opens at 9:45. We're already tapping off this 4-hour PD array. It's going down, and we're tapping off a 15-minute as well. You guys can see this 15-minute fair value gap. So I'm just gonna mark out cleanly. Let's zoom in a little bit. What do we see right here when price ends up closing? So 9:45 comes, the 15-minute closes. We tap into this 15-minute, which is our foundation for this trade. And we can already see here is super simple. We have this IFVG formed right here. Let's go back and replay this when it's happening in real time. You can see here, we have that 15-minute fair value gap, remember this. Price pushes down, forms a fair value gap right here, and we go ahead and end up getting an inverse. This is where you'd enter 30 points. You could target yourself at 1-to-1. Price hits it. All right, so now we're here on Tuesday. What do we see? We see price already tapping into this 4-hour order block, which is fractal. You can see how this high gets taken. We form the order block right here. If we zoom on the 15-minute, we see that we're tapping into this level. We're on the 2-minute time frame right now. Let's see what happens. Okay, price is pushing down. We break above this high, forming a market structure shift. Do we have anything on the 1 minute? As you can see here, we don't inverse this gap. We end up not inversing this as the bodies are not pushing past, but we do form a 2-minute market structure shifts. You guys can kind of get the gist of how this works. Sometimes you're gonna get one and sometimes you're gonna get the other. But for targets here, the most recent opposing confluence can be your target, which would be this 5-minute order block. And you can see how price absolutely demolishes TP and pushes up because we've had our foundation in this 4-hour order block. All right, here we are on Wednesday, and what do we see? We see how price is already tapping off of a 2-hour fair value gap right here, 2-hour order block levels as well. Let's scale down a little. We also see that all-time highs are being edged as we never took them. Let's scale down to the 15-minute. Let's go a little bit closer here. We see that 9:45 does close. Since we are already tapping off a 2-hour, we're not taking liquidity right here, forming resistance. We see that we are pushing up inside this 5-minute fair value gap. We scroll a little bit lower. We see that price does have, in fact, an expansion higher. We edge this high. We see that we have a 2-minute order block right here. We align this with this mid-time frame range. This is aligned with equilibrium. Let's see what happens. Push down. We tap this level perfectly at equilibrium. That would have been our entry right at the order block body. We target the all-time high level with our stop loss, trying to be at 1-to-1 as close as possible. So here's another example of a market structure shift. We don't necessarily have a 1-minute inversion until right here, which you could have also entered off of if you trade inversions. Would not have gotten the best entry, but you can see kind of the gist of how things work. Price retraces back to that market structure shift, order block, to then push up and take the objective. All right, here we are on Thursday. What are we doing? Go down from a top-down analysis. We are tapping into a 2-hour. This could be our foundation for a trade. 1 hour as well, already taking Asia highs. If you guys want to know a tip, I always wait until 9:45 before taking a trade. Take Asia high. That is a liquidity point that we just took right? So that's basis for a retracement. What happens after we take that? You can see after we take Asia high, we end up inversing both fair value gaps on the 1 minute. As you can see right here, your entry could have been on the longest closure, stops at high, targets down here. That could have been a trade idea. If you want to go for a market structure shift, you'd wait here. Price ends up pushing below these levels. Let's see if we get some sort of retracement. Looks like we end up pushing down to tap into a 2-hour order block right here. Then end up reversing bias. Price breaks out of this consolidation, push higher. Let's see if we get ourselves a retracement. Looks like we get one right here. We end up taking a long, targeting these highs off of the 5-minute market structure shift, 2-minute and 3-minute. We see that price ends up respecting this level to then push our way higher. So you can see here, not only do we have a low time frame, but we have a mid time frame 5-minute order block getting respected after we break higher, after we tap into another foundational level, which is this 2-hour order block, which is formed around 10 a.m. as price closes higher. All right, so here we are on Friday, 2-hour order block right here, 1 hour fair value gap below. The 15-minute ends up pushing down lower. Let's go down to the lowest time frame. And there you go. We already have an inversion. We could enter right here, targeting some internal liquidity. Do we end up getting hit though? We do end up getting hit. So there's another example of a trade that's possible off the 1 minute. You can see that many of these are inversion trades, which are very useful for the lower time frame. And if you are targeting some very quick internal liquidity levels, if you want to wait for some sort of higher time frame or mid time frame retracement to continue going higher, you can see here that price ends up taking these buy side liquidity levels, forming a 5-minute shift. Let's see if we enter here, if we get the same similar effect as that inversion for value gap, and we do. So it's all fractal. You really need to understand these two entry models if you want to be profitable. The inversion fair value gap works on the 1 minute. It's very, very easy to take a trade off a very quick high time frame level to then push up to the nearest liquidity level. All right, you can still take pretty much the exact same trade on a continuation by just taking it off the market structure shift. The 5-minute, which is a very strong mid time frame level, gets tapped, aligned with this 3-minute, aligned with these 2-minute order blocks, right? Which price taps into to then continue bullish. So you can choose either one, and they're very, very, very similar. I would say you should play with both of them because not always will you see an inverse for value gap and a market structure shift in the same price range. You will not always see that. So you need to understand both of these entry models so that you can be well-rounded and adjust to any situation given. If you guys learn these two entry models, you will be ahead of 99% of retail traders trading in 2026. All right, please subscribe, like the video, follow me on all my social media, type in the comment section what you think I should make a review on next. So I hope you guys have a great, amazing day and have good luck on the charts. Peace.